Ratio call spread for income. Have you ever wondered how traders can generate income while managing risk in options trading? One strategy that stands out is the ratio call spread. This approach is particularly useful for those who have a moderately bullish outlook on a stock. Let's break it down in simple terms. A ratio call spread involves two main actions. First, you buy a certain number of call options at a lower strike price. Then, you sell a larger number of call options at a higher strike price. All of these options share the same expiration date. The most common setup is one long call to short calls, but you can also see variations like 2-to-1 or 3-to-2. Why would someone use this strategy? The goal is to profit from a stock price that rises moderately but does not exceed the higher strike price of the short calls by the expiration date. If the stock price is near the short call strike at expiration, you can see some nice profits. Here's how it works. As the stock price rises above the lower strike price, the long call gains intrinsic value. Meanwhile, the short calls ideally expire worthless if the stock price stays below their strike price. This setup can lead to either a credit or a low-cost debit, allowing you to generate income or lower your initial investment. The maximum profit occurs when the stock price is exactly at the short call strike at expiration. In this scenario, the short calls expire worthless, and the long calls are in the money. You keep the premium from the short calls and gain from the long calls. However, it is essential to consider the risks. There is unlimited risk if the stock price rises significantly above the short call strike. Since you are short more calls than you are long, losses can accumulate as the stock price increases beyond that strike. This makes monitoring your position vital. From an income perspective, the ratio call spread can provide upfront credit or reduce the cost of the long calls. This effectively produces income while still allowing for some upside potential. It is often chosen when traders expect moderate bullish movement but want to limit the cost of buying calls outright. To summarize, the ratio call spread involves buying fewer calls at a lower strike and selling more calls at a higher strike. It is suitable for traders who are moderately bullish and want to generate income while managing risk. Just remember to keep an eye on the stock price to avoid any unexpected losses.